Welcome, everybody, to this edition of the LPL Research Market Signals podcast. My name is Mark Zabicki, Chief Investment Officer at LPL. Joining me today is Quincy Crosby, Chief Global Strategist. Quincy, how are you this week after Thanksgiving?
I'm good, thank you. It was a good Thanksgiving. The U.S. did a good job at the World Cup, pushing the Lions back and coming out the draw. But we have to now look for the U.S. and Iran. We want the U.S. to win that game, right?
And certainly an interesting game. So it was Friday over the weekend, let's call it. But we are recording this on Tuesday, November 29th. So we've just spent a nice Thanksgiving weekend. Hope everybody did as well. But back to work, as they say. So in terms of what we want to cover today, as we look at the disclosures and move on, just the equity market continues to be somewhat buoyant, perhaps influenced by some conversation around, Fed speculation, which is, seemingly always the case. So not quite as strong over the last 5 trading days as we have seen in the past. U.S. markets up just modestly. Quincy, just in terms of the equity market backdrop, how would you characterize what we've seen from the market over the last couple weeks or so?
It's a market that was able to conquer 3,900. 4,000, and obviously it retreated. But there was an awful lot. I mean, in fact, I think it reached one of the highest points ever of put buying, and that gives you a nice hedge. It allows you in many ways to be more aggressive because you have downside protection. And what we've seen, Mark, is that the market had a nice breath. It climbed higher. And then we saw a pullback. The expectations were, by the way, that yesterday, Monday, that we would see profit taking. This is before, by the way, the market was given a catalyst for profit taking, and that comes from China. But the point is, the market was overbought, technically overbought as we came into this week, and it was expected that we would see profit taking, and we did. So now we've got a week of very important data. We've got Chairman Powell speaking, and there are a number of catalysts for the market to climb higher. Also, if it disappoints, it will probably lead to more profit taking.
Certainly a lot of moving parts in the U.S. and global equity markets. We turn to, let's back up here just a bit. We turn to fixed income, more robust fixed income activity due to the fact that yields have been trending down here of late. Commodities still continue to be some semblance of a problem area. Quincy, we're going to get into that, just a little bit as we talk about one of the big influencers on the commodity market, which is China. But last week, and you touched on it, the FOMC minutes, and it was discussed via the minutes that the Federal Reserve is perhaps looking to downsize some of its rate increases in the coming months. So I think right now, in terms of in the implied Fed funds, we're seeing the likelihood of a 50% or 50 basis point hike in the December meeting. As you put your finger on the pulse of the Fed, Quincy, what is your assessment and your expectation for what are Fed policymakers thinking at this point?
Well, there's an onslaught of Fed policy speakers. Even yesterday, we had the China issues as a catalyst for profit taking. But remember, toward the end of the day, it was Fed speak that, we have to keep going. The terminal rate is probably going to be higher than 5.5%. That theme keeps popping up. And, that's one that the market doesn't want to see. But the fact is we don't know, and I don't think the Fed knows. I mean, that we have this assumption that just because the Fed has an outline of where it thinks it's going to end the rate hikes, they don't know either. So the market, how do I say this? The market has to basically adjust. And we also have, Mark, quantitative tightening, and we can't forget that. Quantitative tightening is the opposite of quantitative easing, which, as we know, liquefied the market, allowed risk taking to the point that the Fed was worried about the risk taking. Even in 2018, when Chairman Powell started to raise rates, it wasn't because of inflation; it was to normalize rates. So the quantitative tightening, $95 billion a month, the winding down of the balance sheet, that is going to add to financial conditions tightening. And the market has a sense of how much, but doesn't really know absolutely. It's certainly going to add to the cumulative effect of the rate hikes already in the economy, and that still working its way through the economy. And Mark, at the margin, we have heard at least two doves in terms of the Fed leadership come out and say that we probably need another 100 basis points of rate hikes. So you get the 50, and maybe right now the Fed funds futures market is looking for another 50 at the first meeting in the new year, which is January 31st, February 1st, where they'll make the announcement. So, they're not going to be finished, but they may go to 25 basis points and 25 basis points after that if they feel more work needs to be done.
Yeah, I mean,
I
mean, certainly a lot of uncertainty, as you point out, and I guess watchers of the Market Signals podcast probably ask themselves, why do they talk about the Federal Reserve every week? Well, I mean, there's a reason for that, because so much of asset price movement really depends on the Federal Reserve policy and what the Fed members do or don't do with policy. And I think there's been some uptick in risky asset prices in recent weeks, largely due to we see perhaps a light at the end of the tunnel. We see some additional visibility of a Fed actually winding down its rate hikes at some point, perhaps in early 2023. So I think market participants have kind of gravitated to that notion. As we mentioned here, even European equity markets have been surprisingly buoyant to the upside, with banks helping to lead that effort. U.S. economic data continues to point to some slowing based on pressures from Fed policy, no question. But so far, I think the deceleration can be labeled as orderly, I think, for the most part. So we'll see how that continues. But those are some of the key issues last week. See, I'm going to kind of turn it back to you on U.S. economic data this week, and clearly we've got jobs numbers, and that's obviously a very important number for the Federal Reserve to kind of digest. But and then GDP quarter over quarter. But how do you think the Federal Reserve is going to look at the jobs numbers? What is the expectation, and what could a strong or weak jobs number kind of portend for markets on Friday?
Well, even before we get to Friday, what's really helping the market, by the way, is the initial unemployment claims and continuing claims. How do I say that? We have to translate it through the eyes of the Fed, right? Because we see initial unemployment claims ticking higher and continuing claims ticking higher. That's good news. Good news if you want the Fed to see that the labor market is beginning to show signs of coming into an equilibrium, right? What they want to see, and what they want to see on Friday, two things. One is that the number of new jobs is lower than expectations. That's one. But also that wages come down. This is important for the Fed, because remember, wages are an input cost, just like anything else. And what do companies try to do? Take that input cost of higher wages and up the prices of what they're charging for their services, the goods that they produce. That's inflationary. So if we see wages coming down, and right now consensus estimates show that hourly wages may tick down just a bit, that's very, very good news. And they also want to see the work week. There's a sub-report within the larger report of hours worked. That's important because fewer hours means the economy is slowing and workers are not needed as much. That's what the Fed wants to see. We'll get a report on Wednesday, the ADP report, that gives you a path towards Friday, but it is the private sector report. Friday's report is a larger, broader report, and it's the one that the market obviously focuses on. But again, it is about wages, it is about hours per week, and they don't want to see a surprise to the upside. A surprise to the downside would be very welcomed by the Fed.
Yeah, agreed. And the good news is current economists are expecting ADP, the non-farm payrolls number on Friday, and also average hourly earnings to tick down from the previous reading. That would be good news, as you pointed out. So we'll see what this week brings, but it's an important one for economic data.
Yes.
Here's what's going to go on outside of the U.S. Some important numbers to pay attention to, particularly CPI in the Eurozone and other producer price index numbers out of the Eurozone as well. This week, as we move through the mid stages of Tuesday here in the U.S., and see the expectation again, we almost get tired of talking about it, but Federal Reserve policy is going to be front and center.
Yep.
Jerome Powell gets a chance to speak on Wednesday. That is expected to move markets. So, it's probably not going to be a surprise what I think you're going to say, Quincy. But what do you think Jerome Powell is going to say on Wednesday? How is he going to jawbone market participants?
Well, he probably looking at least our market and financial conditions easing. We know it's easing. We know the dollar is weaker, which is a form of easing. It's a manifestation of the currency market seeing the Fed stepping down, as you pointed out initially. So that also helps in financial conditions easing. The Fed doesn't want to see that. The Fed wants to see financial conditions tightening, not to the point of breaking something, but tightening enough to have the market less risk on. That's what they want. So he's got to, how do I say this? He's got a fine line to cross, to walk on. He's got to ensure that the Fed knows what it's doing. We always assume, oh my goodness, the Fed knows what it's doing. But let's remember something. Let's remember that the Fed suggested for so many months that the inflationary pressures were transitory, which they were not. The Fed was surprised by the numbers coming out of a CPI report and the University of Michigan inflationary expectations from consumers report. Enough so that during a blackout period, they went to the press and said it won't be 50 basis points, we're moving to 75 basis points. So it isn't as if they are more prescient than the collective of US consumers and folks who live in the real economy. So that said, what he has to do is be confident and ensure for the market that the Fed understands why it is stepping down, not because it's been told to do it by the market, but that it needs to do it in order to assess the cumulative effects, the lagged effects of the previous rate hikes. And that's important because, folks don't realize, because we always look at the housing market, that's the mortgages are predicated on the 10-year Treasury yield. But the rate hikes, and by the way, when they start cutting rates, it takes over a year to work their way into the broader economy. So I think he's got to make sure that we all understand that's why they're doing it. that they have not become dovish, that there is no pivot in the works. This is crucial because the market wants to, how do I say this, jumpstart the Fed's terminal rate. The market wants to see if they can get there first. It's a fear of missing out. It's the idea that, we're not going to wait until the last rate hike before we go into the market. That's so passé. But statistically, that's what used to happen. He's got to get the market to understand the Fed isn't finished, but it doesn't mean that it will be as aggressive as it has been. That's the message. It's a fine line. It's difficult, but he's proven lately that the market does get the memo after all.
Yeah, clearly a balancing act.
Yes.
There's no question, Quincy. Well said. Let's go from that balancing act to another balancing act, which is, and just a few minutes on China. COVID policy and the machinations going on there, and the moving parts, and we'll talk a little bit about commodities as well, and obviously the 800-pound gorilla that is China in terms of its impact on commodities. But so far, Chinese equities are not really showing any signs of real definitive life here. The downtrend is relatively pervasive. So what's going on in China in terms of what they plan on doing with their COVID policy, perhaps, and what implications does that have for perhaps the equity market, global economies, and commodities? A lot of stuff.
And you said 1 minute. Okay, so
take 2 or 3.
Thank you very much. Yeah, it was amazing. So there's so many elements in this. Number one, China led the market to believe, despite the officials saying, no, we are wedded to zero COVID policy, meaning the lockdowns. Yet at the same time, they issued a 20-point white paper, so to speak. White paper means something in here, but a 20-point outline of easing, a targeted policy that would not require as intensive testing. One of the reasons is intensive testing is very expensive. They wanted to move away from that, allow folks to have more, flexibility if they test negative. Then they had an outbreak of COVID throughout the country, including in Beijing. And then they locked down. And the lockdown was ferocious. So ferocious to the point that if you look at the demonstrations, that was actually given more, spark, which is a terrible term, given that there was a fire in a high-rise. However, everyone was locked in. 10 people could not get out. They were locked in from the outside. And so the demonstrations that have followed have evolved, not just ease COVID, not just, be more flexible with the COVID strategy, but we want freedom. We want President Xi gone. It's evolved into that. And the white paper aspect of it is they're walking around with blank white papers that don't say anything, but say everything. China is not going to allow this. They are going to get rid of the demonstrators. It is just not going to be allowed. And so, we saw the market recover, by the way. The market started to recover last night. And there was an announcement that they are going to vaccinate more of the elderly people, or all of them. I don't know how they're going to do it. And you might say, Quincy, why aren't the elderly people vaccinated? Well, they don't believe in it. They're superstitious. They don't trust it. And so many of them have been very vulnerable. One of the things that the market is looking for a more sustainable recovery, like moving away from a trader's market, which it is now, is that perhaps they work with the West. And we know there had been talks with Pfizer's German partner, BioNTech, regarding the technology for the vaccinations that are used in the West and the US. Moderna's used it and Pfizer has used it. The hope is, and when I say the hope is from an investor standpoint, right, that they start using that, because what they've used is a vaccine, China-made vaccine that no one considers it to be particularly effective. But President Xi is wedded to this idea that they want to expunge COVID completely. They want to minimize the number of deaths and not have it be as we've had it in the US. And if that means not coexisting with COVID as we are now in the United States, so be it. However, the underside of it is that you stick with your policy, your economy is tanking, the unemployment rate is climbing, particularly among young people. And so, you might be fighting demonstrations, too many of them, because they're actually winding up. The West is finding out about them. They're actually seeing some film that gets out. What the market wants to see is fix this, make it go away, make the demonstrations go away. And you could say, Quincy, that's so cold-hearted, because I get messages. The market doesn't want any kind of problem. That's just the way it is. And they want to see the economy open. They want to see the factories at work. Remember, China is still an important part of the global supply chain. Just ask Apple about it. Apple's main partner, putting together the iPhones, Foxconn, is offering, small bonuses for workers to stay in the loop. In other words, you don't leave, regardless of what's happening on the outside. You stay there, and you put these together. So Apple's share price really took a hit. There are other companies, I'm not going to go into them right now, but many companies that still depend on China. So all of this has affected, as you've said, the commodity market. Why? Because China is the world's second largest economy, the largest importer of oil in the world. They have a property market. And I should point this out. They are offering special, deals for the property developers. Their loans are in terrible shape. So they're offering lower rates, the ability to even get a loan, because most of these property developers couldn't even get a loan. They've been defaulting. So all of this is part of stimulus. They're requiring the banks to hold less money so that they can lend out more money. But nonetheless, if you're going to lock down an entire country for months, you're not going to spur the economy. One thing that is interesting and perplexing, and it's just a cold. Colds are coming back into fashion now. And that is the 10-year yield on the Chinese 10-year debt is actually inching higher. It's fascinating. It's absolutely fascinating because, the growth is so not available. Why is it inching higher? Is it the market looking at the possibility they get the COVID issue under control, the demonstrations are gone, and they actually can help spur the economy and bolster economic efforts? It remains to be seen. It's still very much a trader's market. And I also want to add, if I may, one last thing. There's talk in the United States Congress that the new Congress may actually come in with a law or a provision that we will defend and make it absolute. It won't be ambiguous anymore that we will defend Taiwan. This is not something that President Xi wants to see out of the US Congress at all. We had a policy of strategic ambiguity for so long, and now both sides of the aisle have been saying, we are going to defend Taiwan. You start putting it into a legalese document, it's going to create a real tension between the two countries.
Yeah, and so Quincy, I mean, maybe the absolute bottom line for market participants is that you don't paint a very good picture for China. Lots of uncertainty, right? Which I think is fairly clear once you dissect the issue as you have, which makes emerging markets a tough bet from a sustainable perspective. Like you said, there may be a a trade here and there, but in terms of the way we allocate assets, we continue to favor U.S. markets over other global, equity markets for a reason. One of those reasons, and tell me if I've got you correct on this, is one of those reasons is the uncertainty in China is just so pervasive. It's tough to sustainably put, a large allocation there. Is that fair?
It's fair. I mean, it's a trader's market. Some say that the U.S. market is a trader's market still now, but we're not traders. So that's the answer. We don't trade. But with all that said, just looking over a number of months, it's clear that the Fed is at the tail end of the rate hike cycle, and the dollar has been weakening. That is going to help emerging markets. It's going to help emerging markets. You will see that as the dollar weakens, the algorithms take over and emerging markets get a bid. But still in all, there's more than just a weaker US dollar that should sustain emerging markets, but particularly China, and particularly this COVID policy. It's hard to invest. Notice I say invest in a country that is still wedded to locking down millions of people for months at a time.
Yeah, agreed. And well said, Quincy. I mean, you raise a good point about the U.S. dollar and the fact that if we see that currency weakening, it does present some semblance of a variable that creates a positive backdrop for emerging markets, but maybe too much to overcome. Right? Is the China uncertainty that you've outlined. So one reason that we're cautious on emerging markets, we remain cautious on other non-US markets, and if we're putting our chips on the table from a more constructive perspective, it is US equities. And that call, I think, has been somewhat rewarded over the last several weeks or so. We'll see what Jerome Powell says on Wednesday about that. Meanwhile, Quincy, I enjoyed talking to you. I appreciate you joining us today in Market Signals podcast on this Tuesday, November 29th. Thank you for your insight on China, and thank you for the insight on the commodities markets and the variable moving parts of China and emerging markets. And that'll do it for this edition of the Market Signals podcast. Thank you, the audience, for joining us. And as always, we'll see you next week.